Hello everybody, it's Dylan Milks here for Thursday, September the 13th, 2012. And what a day it's been today in the markets. What an announcement that came today from the U.S. Federal Reserve Chairman, Ben Bernanke. And that's what I want to comment on today because, I've been reading some articles this afternoon and this evening and kind of watching some YouTube videos of some commenters that I follow and I respect. And there's one slant of this which I think that nobody has really touched on, which I think will which I would like to bring to light, and that is, the Federal Reserve has done this. What the plan was that they're going to buy $40 billion of mortgage debt from the banks per month until they see a dramatic decrease in the unemployment rate. Pardon me. So what they're saying is that, number one, there is no limit in terms of the amount of money that they're going to spend on this. Number two, there is no limit. There is no limit in terms of the timeline or the duration of this. And Chairman Bernanke, in either was in one of his questions he was asked or in his speech itself, he thought that if they proceeded with this policy for another 2 years or 2.5 years, that by the end of 2015, again, if everything goes according to their plan, that by the end of 2015, the unemployment rate would be 6.5% in the U.S. 6.5% if all goes according to his plan. Pardon me. But of course, that's not going to happen. Now let's just look at that from a monetary perspective. If they bought $40 billion for 1 year, that would be $480 billion. 2 years, that's $960 billion, plus another about, let's just say, 2 or 3 months. That's over $1 trillion. $1 trillion in order to get the unemployment rate down to 6.5%. That's a pretty grand goal, I think, and not only that, I think, quite frankly, I think it's completely unachievable, and of course, I think it's just absolutely not going to happen. However, his point of doing this is he thinks that by taking mortgage debt off the bank's books, off the bank's balance sheet, that it's going to free up capital for the banks to then lend out to businesses and as well to lend out to individuals for mortgages. Now, in theory, that sounds like it's going to work. Sounds like in theory that might be a good idea. But here's the point. Mortgage rates now are at their lowest level in history in the U.S. The real unemployment rate, when you consider people who have been long-term unemployed, meaning more than a year they've been unemployed, is about 15%. So the reason why banks are not lending is for a few reasons. Number one, the first reason is because the pool of qualified people, just based on having a job, has basically shrunk dramatically because of the huge rise in unemployment rate. That's the first factor. Second factor is that lending standards have been greatly tightened. So now not only now do we have the pool of qualified buyers has shrunk dramatically, but now the qualifications for getting approved are incredibly strict now. Now, I'm not suggesting that, saying that to mean that how they were, in through the 2000s that led to the housing crisis, that those were good policies. Of course, I'm not saying that at all. But what I am saying is that they're now, even somebody who's had a job, through the crisis, the economic crisis, still a lot of them still aren't able to qualify for mortgages because the standards have been raised so much that they're basically shutting out a lot of the population from getting a mortgage, even if they have a job. And as well, small businesses or medium-sized businesses who want to expand, their criteria now that these businesses have to meet is so much more stringent now that these people are being turned away from loans. And the third thing I want to point out with the banks, why the banks aren't lending, is because the fact that family household income has been continually on the decline since 2000. and especially on the decline since 2008, 2009, since the housing bust in the States. So again, the pool of people is small, is much smaller. The regulations and the amount of risk that a bank's willing to take now is basically almost nothing. They want to take almost no risk, and people's income are declining. So when you add up those three points, that equals no lending by the banks, or very little lending by the banks, mainly for housing, but also even for other things like like cars or any other big ticket items. So when I look at this Bernanke announcement today about we're going to take $40 billion, or almost $1 trillion over the next two years and some months off the books of the bank, with the hope that that's going to encourage them to lend, I look at that and I think, well, wait a minute. Banks don't have a liquidity problem right now. What they have, the problem they have is that the pool of qualified borrowers is so small now that that's the reason why they're not lending. So in my mind, when I look at this announcement, I don't see how adding $1 trillion on the balance sheets of the banks over the next 2.5 years is going to somehow change any of those situations. Now, my theory is that what this is doing is, of course, this is giving basically free money to the banks, which what I believe is going to happen is that they're going to turn around and use, best case scenario, some of that money, worst case scenario, almost all of that money, to turn around and buy U.S. treasuries, U.S. debt. So the reason why I say that is because when you've got 4 years in a row where you've run $1 trillion+ deficits, someone's got to be funding that. And in the early days, in 2009, 2010, parts of 2011, part of that funding of the debt, of the deficit, was done by the Federal Reserve directly buying the U.S. bonds and U.S. Treasury notes. And then they sort of shifted now to the model of, which I think is going to happen, is that now they're going to put all this money giving this money to the banks, sort of like, encouraging them to now step up to the plate and help finance the U.S. government's deficits for the next couple of years. And of course, they need to do this because the deficits are so huge that there's not enough money in the market to buy all that debt that the government needs in order to basically to function on a daily or weekly, monthly, yearly basis. So that's what I really see happening, is that they're just going to recycle that money, a lot of it, if not most of it, into buying U.S. treasuries in order to help finance the deficits. Because that's my theory of what's going to happen. Because again, when you look at those three factors, ridiculously high unemployment, incomes are declining, still to this day are declining, and of course, the pool of qualified buyers is shrinking, and the criteria now has just been so stringent for even getting a loan. Throwing $1 trillion at the banks is not going to change people's employment situation, and it's not going to somehow magically increase people's wages so that they now qualify for these loans. So of course, obviously, that's just my theory, and of course, like always, I'll be watching this, of course, every day for the next, for the next many years to come, and I'm going to be watching it. But I think that's what's going to be happening. This is just a way to, rather than having the Federal Reserve finance the deficits, it's just a way to shift some of that to the private banks, just to recycle that money into buying U.S. debt. So I'll be watching it going forward, and I'll be keeping you all informed on it. So thanks everybody for watching, and I welcome your comments and your feedback on this, on my theory and my idea about what's going on. So thanks for watching, everybody, and hope you all have a great night, and we'll talk again soon. Bye for now.